There are 3 lessons I wish I knew when I started my investment journey. And these lessons didn't just transform my investment strategy over the years, they completely changed my financial situation. If I only knew them earlier, I would have saved a lot of time and a lot of money. In this video, we will explore these 3 rules which can serve as a blueprint for becoming a true investor. Hopefully they will help you avoid some of the mistakes I made along the way, and that can be very useful. As Charlie Munger wisely said, the best way to learn from mistakes is to learn from the mistakes of others. So let's get started. If you want to invest, you first need to be in a position that allows you to do so. The fundamental rule that can transform our approach to money can be found in a book called The Richest Man in Babylon. It tells a fictional story of a man who was in debt and facing many challenges, but he began using a simple rule called pay yourself first. What it means is that instead of paying all the bills, then buying the things we need or think we need, and only setting aside what's left over, if anything, we reverse the process. Every time we receive money, we set aside a certain percentage, 10, 15, or 20%, depending on our situation, and then live on the rest. So basically, what is left is for other people. We buy electricity from others, we buy food from others, we buy cars from others. But this 15% we set aside is just for us. We don't get rid of it, we keep it and let it grow by investing it. Now, you might say, well, I'm not in a position to do that because I have a lot of debt, or maybe my income is too low. In that case, you need to find a way to get yourself into such a position before you start investing. Otherwise, you can get into a lot of trouble. Does it mean you will have to work extra hard? Probably. Does it mean you will have to spend less on your lifestyle? Definitely. But the goal is to set aside at least 10% every month and still be able to live on the rest. That is exactly what the main character in The Richest Man in Babylon did. He worked more, he spent less and paid his debts. And then he was free. Free to start saving money, and later on he was able to start investing. Paying yourself first is the most important step. It allows us to be in a position where we can start investing. You never want to be in a situation where you have to sell your investments to cover essential living costs. When that happens, you lose control of your investment process. If you start investing with money you can't afford to lose, you risk putting yourself in a position where you are more likely to actually lose. So pay yourself first and determine the amount of money you can afford to lose. That way, you can make smart investment decisions free of the fear of losing everything, and also free from greed of chasing quick profits. This approach ensures we are prepared to survive, because tough times will definitely come. When we are finally in a position to invest with money we can afford to lose without it affecting our day-to-day life, we should remember a very wise saying by Kenneth Fisher. Time in the market beats timing the market. The reason for this is that no one can truly know whether we are at the bottom or the top of the market. We might wait for months or years without putting our money to work, or worse, we could be wrong, buying at the top and selling at the bottom. By staying invested and perhaps using strategies like dollar cost averaging, buying an asset such as a stock or an ETF every month or quarter, we give ourselves a better chance of achieving decent results. This strategy moves us further away from speculation and trading, which is not a reliable way to building wealth, to say the least. Staying invested also allows the power of compounding to work its magic. Compounding is a true wonder that helps us create real wealth. And as Charlie Munger famously said, we should never disrupt the compounding effect. Now, for those of you who don't yet know this wonderful effect, let me explain it briefly. If we get a 7% return every year and invest $1,000, after 1 year we will have $1,070. So it grew by $70. But in year 2, this same 7% will bring us to $1,144.90, which is a growth of $74.90. By year 3, it becomes $1,225, so an additional $80, and it just keeps on growing. By year 20, your $1,000 will have grown to $3,869.68, with an annual growth now amounting to $270 instead of just $70 in year 1. That is the power of compounding. Since we can't time the market, the best option is to let the compounding do its job. To take advantage of this, we don't need to invest in specific companies and spend countless hours analyzing different businesses. We can simply buy an ETF or even invest in bonds. However, if passive investing isn't for you, or if you'd like to allocate a portion of your portfolio to specific companies, it's crucial to understand the third lesson. If you want to think of the stock market as a casino, buying low, selling high, and making a lot of trades, that's fine. But understand that this isn't investing. It's gambling. The main difference is that investors treat stocks as parts of a company. Shares aren't just pieces of paper. They represent real companies, real businesses, real buildings, patents, employees, bank accounts, and much more. By changing this mindset, you're not simply buying a piece of paper to sell to someone else at a higher price. You're becoming an owner of a business. And then you approach it the same way you would if you were buying an entire company. If you were to purchase a local grocery store, you'd want to know its costs, revenue, and earnings. Does it have debt or perhaps extra cash in the bank? Is the person running the business a good manager? What is the competition like in the area, and so on? This is exactly the kind of analysis we aim to do when buying shares. We examine the balance sheet, income statement, and cash flow statement. We compare the company to its peers and read news about it to understand any potential problems that could harm the business. Then we assess whether the price is reasonable or not. If the business continues to perform well, its stock price will eventually rise. It may also pay dividends or buy back shares using its free cash flow, increasing its value over time. But if you skip this kind of research, you're effectively buying a business without performing any due diligence. While this doesn't guarantee failure, it can and often does lead to disaster. We all have different paths and starting points, but I believe these 3 lessons can be applied to most situations. Pay yourself first, stay invested, treat stocks as pieces of a company. These are very simple rules, and like many aspects of investing, they are simple to understand but not always easy to implement. But if investing was easy, we would all be millionaires. Thanks for watching and see you in the next one.